Here's something that changes how you see lending forever. When a bank approves your loan, they're not first checking if someone else has saved enough money to lend you. They're doing something that sounds impossible until you see how it actually works. They're creating new money the moment they approve you. And once you understand that, the question stops being, can banks afford to lend? And becomes something way more interesting. Why do banks sometimes prefer the risky borrower over the safe one? I'm going to show you the actual mechanism. No jargon, no conspiracy, just the accounting that happens in real time when someone gets approved for credit. And by the end, you'll understand why a bank might look at someone with bad credit and see a profit opportunity, not despite the risk, but sometimes because of it. Let's start with the part that sounds wrong but isn't. You've probably heard some version of this story. Banks take deposits from savers, keep some in reserve, and lend out the rest to borrowers. It's the piggy bank model. You put money in, they lend it out. Everyone wins. It feels right because it matches how we think about money. Something physical that moves from person to person. But that's not how it works in practice. And this isn't a conspiracy. This is literally how the Bank of England describes it. When a bank approves a loan, here's what happens on their books. They create two entries at exactly the same time. On one side, they record an asset called loan. That's your promise to pay them back. On the other side, they create a liability called deposit. That's the money that just appeared in your account. Both sides of the balance sheet just expanded. The bank didn't go find someone else's savings first. They didn't move existing money around. They created a new deposit when they made the loan. That deposit is new money. It didn't exist 10 seconds ago. Now it does. And here's the one-sentence rule you need to remember. Most money, the economy is created when commercial banks make loans, not when central banks print notes. The physical cash in your wallet is a tiny fraction of the money supply. Most money is just numbers on a ledger, created by lending and destroyed when loans get paid back. So if you're asking, why didn't I learn this? You're not alone. The older textbook story made it sound like banks are middlemen. The modern explanation makes them sound like manufacturers. And that's closer to the truth. But here's where it gets interesting. If banks can create deposits when they lend, what actually stops them from lending to everyone, including people who probably won't pay them back? That's the question we're really answering today. Let's talk about risk. Because once you realize banks aren't constrained by, do we have enough saved up cash, the constraint becomes something else. Is this loan profitable? And here's the part that feels backwards at first. A riskier borrower can actually be more profitable than a safer one. Not always, not automatically, but often enough that banks design entire products around it. Here's how. Banks don't just ask, will this person default? They ask a bigger question. How much can we earn from this loan? And does that outweigh what we might lose? Think of it as a formula. Expected profit equals interest, plus fees, plus any other revenue, minus the cost of defaults, minus the cost of funding the loan, minus operating costs, minus the capital they're required to hold against it. Now watch what happens when the borrower is riskier. The bank can't lend to them at the same rate they'd give someone with perfect credit. That wouldn't be profitable. So instead, they charge a higher interest rate. They add origination fees, maybe annual fees, late fees if payments slip. And if it's a credit card, they're betting that person won't pay the balance in full every month. They'll revolve it, which means more interest. This is called risk-based pricing. The worse your credit looks, the more expensive your terms get. And sometimes those expensive terms are so profitable that the bank still makes money, even after accounting for the fact that some of those borrowers will default. Here's the thing that clicks it into place. The bank doesn't need every borrower to succeed. They need the portfolio to work. 10 borrowers, 1 defaults, but the other 9 are paying high enough rates and fees that the bank still comes out ahead overall. That's the math. And it explains something you might have noticed in real life. Some of the most expensive credit is aimed at people with the least ability to pay it back easily. Not because banks want them to fail, but because higher risk gets priced into higher revenue. And as long as that revenue beats the expected losses, the loan makes sense to approve. Let's make this concrete. Credit cards are the clearest example of this whole dynamic. If you've got great credit, you might get a card with a low APR, no annual fee, and maybe some rewards. The bank is betting you'll pay in full most months. They'll make a bit from interchange fees when you swipe, but the real profit is thin. Now imagine someone with worse credit. They get approved too, but the terms are completely different. A PR might be 25%, maybe 30%. There's probably an annual fee. And here's what the bank knows from years of data. People with lower credit scores are way more likely to carry a balance month to month. They're more likely to miss a payment and trigger a late fee. They're more likely to stay in debt longer. And all of that is revenue. The Consumer Financial Protection Bureau has documented this. The credit card market relies heavily on fee income, and a lot of that fee income comes from economically vulnerable consumers who end up paying late fees repeatedly. So when a bank looks at a borderline applicant, they're not just seeing risk. They're seeing a customer who might pay high interest for years, rack up fees, maybe buy other products later. It's a revenue bundle, not just a loan. Does that mean every risky loan is profitable? No. Some borrowers default completely, and the bank loses money. But across the whole portfolio, if the high-yield loans bring in enough to cover the losses, and then some, the strategy works. And it has worked, historically, which is why the market exists. The dangerous part, and we'll come back to this, is when too many banks start thinking the same way at the same time. But let's pause because there's a question you're probably asking. If banks can create deposits when they lend, and risky borrowers can be profitable, why don't banks just lend infinitely? This is important because the answer is they can't, and the limits are real. First, capital. Banks are required to hold a certain amount of capital, essentially a cushion of their own money, against the loans they make. Riskier loans require more capital. If a bank runs low on capital, they have to stop lending or raise more, and raising capital is expensive and dilutes shareholders. So capital is a hard constraint. Second, liquidity. Even though loans create deposits, banks still need to manage cash flows. If depositors want to withdraw money, or if the bank needs to settle payments with other banks, they need liquid assets. Running out of liquidity is how banks fail, so they can't just lend without thinking about funding stability. Third, regulation. After every financial crisis, regulators tighten the rules. Stress tests, leverage limits, underwriting standards. Banks that violate these don't just get fined. They get restricted or shut down. And fourth, profitability itself. A loan that looks good on paper still has to clear hurdles. Can we fund it cheaply enough? Will the return beat our cost of capital? If we make this loan, are we crowding out a better opportunity? So the real break on lending isn't we ran out of deposits. It's we hit our capital limit. Or this loan doesn't clear our return threshold. Or regulators won't let us go further. That's why banks don't lend infinitely. But here's the twist. Those limits move. In good times, capital looks more plentiful. Defaults look rare. Competition heats up. And suddenly, loans that looked too risky last year start looking profitable this year. That's when things get interesting. Let me show you how this plays out over time, because this isn't just a banking story. It's an economic cycle. Imagine the economy is doing well. Unemployment is low. Defaults are rare. Banks look at their loan books and see strong performance. Profits are up. Regulators are relatively happy. Shareholders want growth. So what happens? Banks start competing harder for borrowers. To win business, they ease their standards a little bit. Maybe they approve someone whose credit score is a bit lower than they used to require. Maybe they lower the down payment on a mortgage. Maybe they offer a loan that used to need more documentation. These are marginal decisions, maybe borrowers, not obvious disasters. And in the moment, it looks smart. Loan growth drives earnings. The new loans are priced high enough to look profitable. Defaults haven't spiked yet because the economy is still strong. So every bank's quarterly report looks great. The Federal Reserve tracks this. They survey senior loan officers and ask, are you tightening or loosening standards? And what you see historically is that standards loosen in expansions and tighten in downturns. It's a wave. And research shows that when lending standards ease, credit grows faster, and that credit flows into the broader economy, boosting spending, asset prices, and output. It feels like prosperity. But here's the thing about risk. It doesn't show up immediately. When you approve a loan to someone who's a bit shakier, they don't default in month one. They might take a year, or 2 years, or 5 years to run into trouble, especially if the economy stays strong. So the bank is booking revenue today from those high-interest, high-fee loans, but the losses arrive later. And losses are lumpy. Revenue is gradual. That's the trap. Bad lending can temporarily look like good performance. It flatters earnings. It attracts bonuses. It makes everyone look competent. Until the cycle turns. When the economy slows, or when interest rates rise, or when something external shocks the system, suddenly those marginal borrowers start missing payments. Defaults spike. The loans that looked profitable on paper start generating losses. And because many banks loosened at the same time, the losses hit the whole system together. That's a credit cycle. It's not a conspiracy. It's just what happens when profit-seeking institutions respond to the same signals at the same time. There's one more piece that makes this even more interesting. Sometimes the bank doesn't even plan to keep the risk. This is where the originate-to-distribute model comes in. The idea is simple. The bank makes the loan, earns fees from originating it, and then sells part or all of it to investors. Pension funds, insurance companies, other banks, they buy bundles of loans as investments. And when that happens, the incentives shift. If the bank knows it's going to sell the loan, it cares a bit less about whether the borrower will actually repay over the long term. What it cares about is, can we make this loan, collect the fees, and pass the risk to someone else? That doesn't mean every securitized loan is bad, but it weakens the monitoring incentive. Research from the New York Fed and others has documented that when banks expect to sell loans, underwriting quality can decline. And during the lead up to major crises, this is often part of the story, loans that looked profitable because someone else would be holding them when they went bad. So now you've got banks that can create deposits when they lend, that profit more from riskier borrowers, that face competitive pressure to grow, and that can sometimes offload the risk to others. What could go wrong? Well, history answers that pretty clearly. Here's the pattern you need to see. The dangerous moment isn't when banks stop lending. It's when lending still looks profitable because the losses haven't shown up yet. That's the delayed pain problem. Revenue comes in now. Defaults show up later. And in between, everything looks fine. Earnings are strong. Stock prices rise. Bonuses get paid. And more banks pile in because they don't want to miss out. The FDIC has explicitly warned about this. They've said that high earnings from lending can sometimes reflect a greater degree of risk in the asset base, including high interest, high risk loans. In other words, strong numbers today don't always mean safe banking. Sometimes they mean the bank is taking risks that simply haven't blown up yet. And when many banks are doing this at once, when the whole system is leaning into risky but high-yield lending, you get the conditions for a crash. Not because any individual bank is stupid, but because the collective behavior creates fragility that no one can see until it's too late. That's what happened in the run-up to 2008. Standards loosened. Lending grew. Securitization spread the risk around. And for a while it looked like genius, until it didn't. So let's bring this back to where we started. Why do banks want you to borrow even when you're risky? Because they're not really asking, can we trust this person? They're asking, can we price this risk profitably? And when the answer is yes, when the interest, the fees, the portfolio math all line up, risky borrowers can be just as attractive as safe ones, sometimes more. This doesn't make banks evil. It makes them profit-seeking firms operating under a specific set of rules. They create money when they lend. They're constrained by capital, liquidity, regulation, and profitability. And within those constraints, they try to lend as much as they profitably can. But here's what you need to remember. Just because a loan is profitable for the bank doesn't mean it's good for the borrower. High interest debt can trap people. Fees can spiral. And at a system level, too much risky lending, especially when standards loosen all at once, creates the conditions for a credit boom and then a bust. The next time you get a credit offer that seems surprisingly easy to qualify for or surprisingly expensive, you now know what's happening behind the scenes. You're not just being assessed for risk, you're being priced for profit. And the bank has run the numbers and decided you're worth it. The question is, are they worth it to you? That's the model. That's the mechanism. And that's how the system actually works.